Hey there, how you doing? Welcome to the channel. So today I'm gonna get some zombies here, and then we're gonna talk about a little bit about weak hands and strong hands, and I want to kind of show, um, what the difference is. Basically, when you look at a stock that's been running, you have people that may have bought the stock very early on, and these people are typically you would think of them as the strong hands, and the reason would be is that they may have bought the stock at a very low price. And so if they're still holding on it and the price has been going up for a long time, then, the stock can take significant corrections and it doesn't really matter, right? It's not really a problem for them because they're still in the money. They still have made money on their trades. So they're less likely to feel pressure to have to sell. So, yeah, so that's kind of what the difference is between strong hands and weak hands. Now, usually it's on price, like where you bought it, but it doesn't necessarily need to be that way. It could be on other factors, right? It could be on the type of holder. So another example would be if you have people that are buying a stock on margin, they tend to be a weaker hand, a weaker holder. The reason is because if you bought a stock on margin, and if that stock has any move down in price, because you're basically that person is buying, borrowing money to buy that stock and hold it, they can get a margin call. So basically, if you had, for example, if you were had borrowed 50% of the money to buy a stock, you have to understand that your broker, if that stock starts going down by something like 10 or 12% or a significant amount, they're going to start getting very nervous about that position because basically the broker doesn't want to get stuck holding the bag. So you can imagine that if in a really extreme scenario, if if they lent you 50% of the money and the stock went down 50%, um, then basically, they're at the point they're at the point where they're kind of in really trouble, right? And if it goes down anymore, then you don't have the money to pay them back, right? So this is kind of like an example of a weak holder being someone that's over leveraged. Now, the leverage can come from different places. The leverage can come from other lending sources. You don't have to borrow from your broker. You could borrow from some other bank or some other institution. And this is why, people try to track, people's, whatever the amount of margin is out there and that kind of thing, and the credit balances and margin accounts and all that stuff to try to get a feel for how overextended people are in the market or not. And because once again, the more extended people are, the more likely they are to get a margin call. But even if they don't get a direct margin call, for example, if you're some kind of hedge fund and you were able to talk a financial institution into giving you $100 billion, and you went out there and had a bunch of stocks on that, they might not know that, like, well, okay, how risky the positions that this hedge fund had bought. But the thing is, the hedge fund knows it. And so they certainly get kind of concerned if they're like buying stuff and they're getting hit with it. They're less likely to want to hold on and be long and strong on something, or short and weak, or whatever it's called. But yeah, so these are the reasons for weak hands. So the reasons generally are really anything that is going to force you to sell when you don't want to sell. It makes that entity or that person a weak holder. And so just given the nature of things, we can find ourselves in situations where, a particular stock can have a bunch of weak holders versus stocks that have maybe strong holders. And so that's kind of just some of the things that are out there. Now, the question is really, can you detect this? Well, that's harder to tell. That's not really clear. So I think let's go to this. I want to show another example of this. So what I'm going to do is I'm going to share this whole thing here. It's going to do it the way I want. And sure. Okay, I think that did it. And what I have is I have this. You should be seeing stock chart and this. Okay, so what I wanted to do is take an example. So over here on the left, I have our Tesla here. So I got a Tesla weekly chart. So this thing is going back about 2 years, 2-year chart. It's over here now. It's trading in the 800s to 700s range. I mean, it's trading a lot. And one of the things that I wanted to do is kind of show an example of why sometimes a stock peters out, why it becomes difficult for it to always go higher and higher and higher. So what's happening here, what I did is I took a bar like this, and I it's not totally perfectly accurate measurement of things, but it just gives us a general idea. And I think the principle behind it kind of stands up. So we take this bar and we look at the move of this bar, and we can see here that this bar, about that much of a move. Now we're on a whatever kind of chart, non-linear chart, so that makes it a little harder. But a similar move on this day, because this thing is trading, and that's what I have over here, is it was trading, and on that particular day, which was a nice strong, week, a strong week, the price moved from a low of 51 to 65, and this was like opening to closing price. So it's a $14 change that week. And I called the volume about 200. Actually, the volume was 390. So I'm going to change that. I'm going to make this 390 million shares that week. All right. So that was 390 million shares. So the point is, if I take, that's the amount of volume it took to move that stock from 51 to 65. So if I take the price change, multiply it by the volume of that week, I get this delta P times V of $5 billion, $5.46 billion. So the point is, when the stock is at that kind of pricing, various institutions, people, investors coming in, deciding to buy the stock, you only need $5 billion of people coming in to buy to move that stock. So now we go forward out here. We're going to go to another bar, similar type of bar in terms of the range on it and stuff like that. But I mean, it is somewhat different. But here, the price moved from 118 to 150. So here was a $32 price move. Now, once again, percentage-wise, this may be, I can do the percentages, but it's probably similar type of percent move. Let me do that. Let me see. So what I would do here is take the $14, divide it by the beginning price, which was the low. These are all up bars, and we're just going to record that. Yeah, so you can see here. So you can see that both of these are, and I'll just mark these as percent so we're clear. You can see these are all about 27% moves, 27, 27, then a 22% move for the last one. So you can see this bar here, similar bar, similar type of move, but here, because the price is so much higher, that it took, and there was a lot more volume, and the price move was more in terms of absolute amount, but it took 12.9 billion to make that move. So as the price goes higher, to keep it pushing up, it's requiring larger and larger amounts of capital, of money, to come through that stock, to trade into that stock. And then we go to this where it's way up here. And now we have a price move from 719 to 880. Now, interesting here, it's a $161 price change, but it's only 22%. So it's not as much of a move. But to make that move, and the volume here was different. The volumes are changing each week here, but 252 million, and it took 40.5 billion. So the point that I'm making is that for a stock to keep going up, it requires continuously larger and larger amounts of capital to come into that stock. You can see here, just in this simple example with Tesla, that $5 billion coming in could move the stock 27% in a week, but now it's like 40 billion to make not even as much of a move. Okay. So this is something to keep in mind. And if you think I'm crazy and it's like, this doesn't matter, it does matter. And I would encourage you to go to IBD, Investors Business Daily, and look at his philosophy, because, you know, in his books, he talks about this. He talks about, you know, a stage 1 base, or a stage 2 base, or a stage 3. And, you know, he does make basically this exact same kind of point here. It's like, if you've had a breakout from a stage 1 base, you know, you have much better success of that making it a significant move higher if it's met all the criteria. You know, as you get to a stage 2 base, it gets harder. And a stage 3 or stage 4, it gets harder and harder, because why does it get harder and harder? Because to get out of those things, and the price, if the higher the price gets, it just requires more money. It's just a natural law of numbers. It's just how it works. You know, it's not, I'm not making this stuff up. That's how it works. So this is something to keep in mind. And so you have the dynamic of, it requires more and more money to come in. And then also, the people that are buying at higher amounts are weaker hands. You know, like, once again, if you had bought way back here and you bought at $50, $60, you know, oh, the stock went down $100, you don't care, right? Because the current price is trading, oh, it's 900, it went to 800. You don't even care, right? So you're what we call a strong hand. And even these people back here that had bought it like a year ago, they're still pretty strong hands. But people that are buying it now, people that were buying in this week, they're losing money. They're nervous. Not only that, they're nervous from the perspective that, look, they're like, the people that bought this week, many of them are just already in the hole. You know, they're already negative in their position. So they have to decide, well, did I make a mistake? Should I get out, or should I stay in? Should I ride it? But in addition, they had to put a lot more capital in to get that move. So they're like double weak. So this is something to keep in mind. When people are out there and they're trading, and you Robin Hood kids are going crazy out there, you know, have your fun, but just kind of keep in mind that, you know, it takes a lot of money to move this stuff, and nothing is different this time. It really is the same. This here, this doesn't change. This is just a natural, you know, the more successful a stock is, the more issue it's going to have going up. So you can imagine that why have we benefited from such a huge stock market move? And, you know, I would say it's because of all the Fed money printing. Now, I know the George Gammons and all those, like, they don't print money, blah, blah, blah. Right, they print reserves, but at the end of the day, they stack reserves on the balance sheets of these banks. And you just do that enough, and you'll get them to do some lending. That's what it really is. I mean, it does correlate perfectly well. You know, the money supply, the bank reserves, the balance sheet going up, and the stock market going up. There is a correlation there. It's not a one-to-one. It's some fraction, right? It's some differential equation or something like that. And that's fine. And it's good to know that, because there's a lag, right? It's not a one-to-one thing. So if the Fed prints $1 trillion today, you know, trillion doesn't show up in the market tomorrow. You know, there's all these factors. And I think that's really the good point that they're getting at. But in the big picture, that's why stocks can keep going up. Because you can do this with the S&P 500. You can do this with the whole market, and kind of figure out the market amount of money that's got to come in to move that market. And and it's the same thing with the SPY, you know, the biggest ETF out there representing the S&P 500, you know, same kind of deal. You can do that analysis, and you'll just see that this is exponentially growing curve. You know, they got to keep putting more and more money in, so more and more finds its way into the market to go into those stocks. And if they let off, then it's fine. If they let off, it's fine, unless something goes wrong. There's any little hiccup, any little selling, there's no one to come in and buy. Because you can imagine, like, you know, you have a down day up here in the 800s and the 900s. Well, it's like, you know, there's a big air pocket before people can, like, start. Even if they wanted to buy it, they may not have the money. You know, if it took 40 billion to move it from 700 to 880, and now it sells off from 880 down to 700, Well, okay, you just evaporated like however many billions dollars that is. And like, well, you don't have the money. Who's got the money to put new money in? You got to find a source of money to put back in to push it back up. And that's sort of the issue that you have. So that's it for that one. So, big picture here, just trying to keep big picture in mind that, this is the WeakHands. Here we go today. Just comment on GameStop really quick. We have more shenanigans going on. Look at that thing move. This thing went, oh my gosh, went up 100% or something, 103%. Huge volume. Let's look at the 15-minute. What I had heard, this was at the end of the day. Yeah, in the last hour, couple hours, they really ramped it up. Massive volume too. So, yeah, that's going to be a mess. This one makes me curious because, like, from an engineering, like electrical engineering point of view, it's a very interesting disturbance in this signal. It's as if this is this is a signal that's at a ground state where a neighbor is switching and you're getting a crosstalk impulse on it. And then I wonder, like, what if it's going to come back in and hit it again. It looks to be hitting it again. Here's what I normally see in these kind of things, really volatile things like this, is that you normally will not see and this is not financial advice, this is just me from what I think I've seen, and I'm not trading this thing, and go do your own thing. I would find it very hard to believe that it could get much further than where it was before. So my guess would be, you had this initial impulse pump that really hit 500 almost. It's not going to get anywhere near there. That's fine. I could be proven wrong tomorrow, and that's fine. So let's see if I was wrong on anything today. How about we do that? So let's take a look. One thing I was looking at was FDX. I did think I did buy some of this today. So it's just a setup. You had the downtrend coming here, but you have this, it's kind of reversing. It's building a base, and some people would call this maybe a reverse head and shoulders, but I'm not looking at it that way. I'm not looking at like reverse head and shoulders and stuff like that. I'm just looking at it. Hey, look, you had a hammer. So this is something had a hammer. You have it. It's making a move above the 50. The red is the 50-day moving average, reasonably important. And it may had a strong bar today. I didn't get a great price on it, but like if this thing does move and it breaks this high, we definitely have a nice swing there. So that's why I bought a bit of that today. You shouldn't do that. You shouldn't do anything. I do. Peloton. This one didn't go well. I put a buy point. See here what I'm doing, another hammer, and I'm trying to just say if it goes above this, and I think I need to check, but I think it actually filled because I put it a little too low and it filled and then it went down. So it really was just a terrible bar. But on this kind of thing, I'll give it a little bit of time to let it run and see what happens. Notice I'm looking at EPS dates, earnings due. I'm trying to avoid them. See, earnings came out earlier this month, so I don't want to be around the earnings. So I'm trying to be disciplined about like when are the earnings expected to come out. So those are the two things I saw today. Grayscale, this thing. It's trading with Bitcoin, and I know you can look at the Bitcoin charts, and that's fine. I just look at this chart. It's not exact. I get it. The only thing, like if I look at this chart, it's still in an uptrend. You have the 50, the 25 going up. You have the 200-day, the 150-day. Everything's moving up. It's finally coming into support. Look at that bar too. See that bar from yesterday? Look how it hit the moving average and came right up. So that's not a super great hammer. It's not a hammer with a little, like this little hammer is a better hammer, but that's positive from the point of view that the thing hit the moving average, bounced off it strongly. Now, this thing is so overdone, who knows where it'll go tomorrow. But the big picture is still kind of an uptrend. But just based on the last thing I was talking about, you take, okay, it's at 58 times whatever the volume was for that day. 58 times a volume of 18 million. I don't know what that is. It's a lot. It's a lot. And all that applies, so this is sort of the thing that's kind of creates the issue for you know, getting Bitcoin to 1 million. You know, it's like you got to have so much money coming in there. So I think that is it for this one. Thanks for stopping by. Talk to you later. Bye.